Hi guys. Today we will analyze Raytheon Technologies stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The long and short-term trends are both positive. Strong support levels are around $90 and $82. Next strong support level is around $75. Strong resistance level is around $105. In the last month the stock has been trading between $88.50 and $100.60 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 5.5 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 6% per year, for last 5 years. We see that the average profit margin of the stock has been around 4% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 149% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Raytheon Technologies Company: bad, average, and good. First scenario. Raytheon will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 8%. Future profit margin would be low, 4%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $33. Second scenario. Raytheon will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 10%. Future profit margin would be average, 5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $47. Third scenario. Raytheon will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 12%. Future profit margin would be high, 6%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $65. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.8. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Raytheon Technologies, analysts forecast growth rate around 10% per year in next 5 years, and future P/E around 21. Again, I will use 3 different scenarios for Raytheon Company: bad, average, and good. First scenario. Raytheon will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 8%. Future P/E would be low, 16. In this case, the fair value of the stock today would be $38. Second scenario. Raytheon will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 10%. Future P/E would be average, 19. In this case, The fair value of the stock today would be $53. Third scenario. Raytheon will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 12%. Future PE would be high, 22. In this case, the fair value of the stock today would be $72. As you can see, today the stock is overvalued, $99, even if we expect the company's high performance in future. While the company is still in line with the averages on profitability rating, there are some concerns on its financial health. Also, the company is expected to show small to medium growth in the next 5 years. Based on that, the stock looks overpriced at the moment. I may consider buying the stock for the dividend, when the stock drops to $70-$75. Company strengths. Raytheon Technologies Corporation is an American multinational aerospace and defense conglomerate. It is one of the largest aerospace, intelligence services providers, and defense manufacturers in the world by revenue and market capitalization. It researches, develops, and manufactures advanced technology products in the aerospace and defense industry, including aircraft engines, avionics, aerostructures, cybersecurity, guided missiles, air defense systems, satellites and drones. The company is a large military contractor, getting a significant portion of its revenue from the U.S. government. The missile and missile defense segment makes products that are prioritized by the National Defense Strategy, which should lead to consistent growth. Also, analysts expect strong long-term demand growth for commercial and government aerospace applications. The company is well balanced between commercial aerospace and defense, which would partially insulate the firm from a downturn in either segment. The company's profit margin of 6.5% is amongst the best of the industry. Its return on assets of 2.6% is comparable to the industry average of 1.1%. Risks. Raytheon Technologies is a key supplier to the U.S. military, and thus vulnerable to debates over and potential cuts in domestic and international defense spending. The company is subject to a number of procurement laws and regulations, and evolving U.S. government procurement policies, and increased emphasis on cost over performance could adversely affect Raytheon's business. The defense industry is competitive, with other deep-pocketed players. Boeing and Airbus have taken increasing interest in compressing the margins of their component suppliers, such as Collins Aerospace. The company generates substantial revenue from overseas, and its results are typically linked to global economic trends. Increasing complexity of modern aerospace products, as well as cyclical demand from commercial customers. Technical errors in aircraft engines or systems can cause significant losses and reduce customer trust. The company's return on equity of 5.8% is worse than the rest of the industry. The industry average return on equity is 10%. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 10% on average per year. The earnings per share is expected to grow by 10 to 12% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.